Picture this for me. You've chartered a discount flight across the country and you find yourself in a somewhat outdated plane with a veteran pilot but no cruise control. The pilot wakes up suddenly and realizes he's been asleep in the cockpit and that his plane has drifted upwards to too high of an altitude. However, instead of correcting and immediately slowly descending the plane to the proper altitude, he doesn't believe in the instruments and he starts to question it. He looks at it and he thinks this can't be right, so he decides to monitor the situation. Well, eventually he realizes that it was correct and he is too high and he starts to descend. However, instead of, because it's too late, slowly descending the plane to the correct altitude, he takes a nosedive. Picture you're in that spot real quick and think, would you want your pilot using the current altitude to decide when to pull up, or do you want him using an average of your last hour's altitude to decide when to pull up as you're careening towards the earth? That, my friend, is the predicament we find ourselves in with the Fed and inflation. In this video, I'm going to break down 3 things that are going on right now and how it affects home buyers in the current economy. Number 1, we're going to talk about how inflation is driving interest rates and what that means for home buyers. We are going to talk about the good old basic economic principles of supply and demand and how that's affecting the real estate market right now. And number 3, we're going to talk about what comes next and what to do about it. Much like an airplane, our economy is made up by a series of complex relationships of switches and levers. Right now, one of the key levers that everybody's monitoring is inflation. Now, if you look at inflation on a month-by-month basis, it can be too limited of a data to do anything with. So Fed typically looks at an entire year's worth. And if when they report inflation figures, if it looks like inflation is going up, rates go up with it, again, through a series of levers. If it looks like inflation is going down, rates come down with it. Now, because it's an annual figure, we can look at what the new data is replacing from a year ago. We don't know what inflation is going to be, but when you know what it was a year ago, and if it looks like inflation was higher a year ago, then there's a good chance it's going to look like it came down or at least stayed level in the future. If it was low a year ago, it's going to look like it went up. So a lot of what we know about the future of interest rates is tied to what we know about the history of inflation, coincidentally. Now, what that means for home buyers is that we are coming through a period where new numbers were replacing low numbers and it looked like inflation was going up. At this point, however, going into the next 90 days or even 180 days, we are starting to replace the higher inflation figures of last year. That is going to give inflation a good chance to look like it's going down. And when that happens, it is very likely, and this along with a series of other factors that we don't have time to get into today, is leading a lot of experts to believe that lower inflation reports, lowering the margin between the 10-year treasury and interest rates and other factors is going to lead to lower interest rates in the next 6 months and as early as the next 60 to 90 days. Now on to home prices that are primarily governed by the age-old economic factors of supply and demand. Well, if you go back to 2008, the last time the real estate market experienced a significant decline, actually the most significant decline in history, it was mostly because mortgage products had created an unsustainable level of demand, and home builders were building homes at an alarming rate, in addition to an occasional dip in the population that occurred at the same time. What that created was a huge gap between demand and supply. Right now, we have the opposite thing happening. The population has grown, the number of first-time home buyers is increasing, and because they are scared primarily of 2008, home builders were not as quick to resupply the market. So we have the exact opposite situation that we had in 2008, where demand still outweighs supply. When part 1 of this story happens and interest rates come down, demand is going to go up further, which is going to create even more of a demand versus supply gap, and real estate prices are likely to go up. Furthermore, the actions we talked about the Fed taking, primarily raising the short-term interest rates, are having an effect on the economy, and we are likely to see a recession. That leads a lot of people to worry, are home prices going to drop? Well, as you've seen in most of the country, home prices are not dropping. And if you look at the charts, home prices usually do not decline during a recession, with the one outlier being 2008, which we already described. So what does that mean for home buyers and what happens next? Well, perhaps more than any other time in history, media companies are incented to create fear in their readers, watchers, and listeners. And perhaps because of that, more so than any other time in history, buyers are driven by what they're hearing in terms of headlines and in the media. And right now, those are causing fear of a housing bubble and the real problem of interest rates impacting affordability. Well, as real estate's interest rates start to fall, as mortgage interest rates start to fall, we are likely to see a bunch of those buyers who are not buying right now, who are not needing a house any less, start to enter the market, and we are likely to see a frenzy of home buying, much like we did in 2020 and 2021, which is going to make it a seller's market once again. The demographics, the supply and demand we talked about, is likely to buoy that sentiment for years to come until home builders have a chance to catch up supply inventory. In the meantime, we have about a 60 to 90, maybe 120-day window before that happens, where interest rates are high, expected to come low. Housing bubble fears are creating an opportunity for people to buy homes right now without the competition that they used to have. But the actual statistics imply that we are not in a housing bubble, and in fact, we have several good years of appreciation to come. I would rely heavily on the average historical home price appreciation that we've seen throughout the last 63 years, and not the crazy inflationary home price appreciation that we've seen over the last few years, although I could be wrong. We could see double-digit appreciation again. Certain parts of the country have already seen a pullback while others have remained steady, but certainly as more demand floods the market, it's going to act as a stabilizing and increasing force in terms of home values. Perhaps the most savvy thing to do would be to beat the rush and buy a home in the next 60 to 90 days if that's what you need to do for your family. That would allow you to strike while others are in fear and sort of profit on that as you buy with less competition. If interest rates go down in the future and you're in a home you can already afford, you do get the additional benefit of potentially being able to refinance into those lower rates anyway. However, at that point, you already own the home and you're not competing with anybody else. If you or somebody you care about is in the market for a home, there are really a couple different courses of action. One, wait till interest rates come down. A lot of your peers are probably going to be doing that too. And so you will be in a situation where you are competing for, again, very historically limited inventory, and the affordability will be greater because interest rates are lower, but we are likely to see home prices go up at that time. The other option, which we just talked about, is to strike now and buy now. And if you are interested in doing that, there are actually products that are specially designed to sort of bridge the gap between now and when interest rates go down. Because even though we still have limited inventory, there is a temporary dip in demand. Sellers are often, more often than they have been in years, willing to negotiate with you, and you could potentially get a better price in the house. But more savvy buyers will use that potential for negotiation and negotiate seller credits, which can then in turn be used to buy down the interest rate now in terms of permanent or temporary buy downs. If you do not feel like rates are going to go down in the future, then you would want to choose a permanent buy down. If you do feel like rates are going to go down in the future, that's where a temporary buy down could be right for you. Get tomorrow's interest rate today and retain the capital investment to be able to refinance without losing that money in the future. If you have any questions, please reach out to me and my team. We're happy to help you, and I appreciate you watching this message.